Ladies and gentlemen, family and friends, scholars and dignitaries, welcome to another episode. Welcome to my world.
Hello, friends. So, when one speaks of the quality of life, financial security and money management need to be considered as much as anything else that contributes to a standard of living. Yet, money management is either the last thing considered by most of us, or if it is considered, it's often given superficial consideration at best. I know that when I was young, I really didn't give much thought to a retirement fund. In fact, I didn't give any thought to it at all. Anyway, does anyone really need a $400,000 home? Does one need a $30,000 car? Does one need a $30,000 wedding, a $10,000 diamond ring, or a $10,000 vacation? In America today, the average family household is in debt, big debt, and not just because of mortgages and student loans, although that is a large part for sure. In total, household debt increased to $15.24 trillion, according to the Federal Reserve Bank. Today, the average family has over $150,000 in debt. That includes a wide variety of obligations, including home mortgages, home equity loans, car loans, furniture loans, but especially credit card debt, because more Americans may be leaning on credit cards to make monthly payments, much less special purchases. The average person now owes $54,000 in debt. Households in the U.S. owe over $900 billion in credit card debt alone, and the average family credit card debt is now between $6,000 and $15,000. For households that carry credit card debt, it costs them over $1,000 a year in interest alone. Just the interest can be stifling to most families, and now you begin to understand the true ramifications of out of control spending. All financial experts have agreed that family debt is out of control. Not all the debt, of course, is frivolous. The rise in the cost of living has outpaced income growth over the past decade. And now, with a hyperinflation, the spike in home purchases have increased. The cost of purchasing cars, even used cars, has increased. Utilities, including phone services, cable television, and internet services, have all increased. The cost of college and or student loans are at an all-time high, and medical, dental, and health insurance have all increased at rates far beyond the traditional cost of living adjustment. In fact, food and household consumables are as much as 33% higher. That being said, while many of the necessities of life have increased over the past decade as much as 33%, increases in salary just haven't kept pace. Thus, the answer is that families have to cut spending on optional areas. For this point, consider the lifestyles of our grandparents as our role models. Grandparents often did not have the resources we have today. For them, life was about survival and living on a lot less money. They lived through the Great Depression. They needed to work to survive, sometimes two or three jobs, and they knew the importance of money as a resource. For them, it often meant the difference between life and death. They learned that the first principle for money management was, quote, to live under your means, not within your means, but under your means. That was the key. The second principle they learned for money management was to, quote, live under your means. And the third principle for money management they learned was to live under your means. You see, they knew that everyone wants your money, but they had to protect it. Grandparents didn't spend it foolishly. They were frugal. They were thrifty. They learned fast that there are really three options everyone has. You can spend over your means, you can spend at your means, or you can spend under your means and save the balance for a rainy day. And that's something we don't do today. Everyone should have enough money in a savings account to cover a minimum of 6 months of bills and essential living expenses, at least for 3 months. But ideally, everyone should have 6 months worth. But according to the Federal Reserve, about 50% of American households don't even have $400 saved to cover an unforeseen emergency, like new brakes for the car or an emergency dental bill. So, getting back to our grandparents, they learned the difference between wants and needs. They knew that if they needed something, they would buy it, but only after shopping for the best price, negotiating, or using coupons and related discounts. On the other hand, if they only wanted something and didn't need it, well, that was usually put on the back burner and they would just pass on the purchase. Grandparents learned the importance of savings. They knew that everyone is out to take your money and didn't care what your financial position was or how or if a purchase would burden you or even leave you broke. They knew that only careful planning and spending could protect them, their families, and their money. Their motto became, quote, save. Save your nickels and dimes, and the dollars would save themselves. They became very thrifty by necessity. To them, thrift was not a dirty word. They lived a frugal life and were better for it. But they weren't cheap. They were very generous in sharing what little they had and were quite generous to charity, to their church, and to those in need. But today, 86% of Americans live from paycheck to paycheck. They have no savings and little or no pension saved for their retirement. In one recent year, over 1.5 million people filed for bankruptcy. Financial problems plague Americans, and not necessarily because they're out of work, but because they mishandle the level of income they do have. The old timers had it right. They knew about money. Many had to work 2 or 3 jobs to feed their families, and many lived through not just the Great Depression, but numerous depressions and job losses and financial constraints. These are not people who understand paying $250 per month for television when television should be free. They wouldn't understand paying $125 per month for a phone. They did not go on expensive vacations, wouldn't go out for a $100 dinner, wouldn't own a $30,000 car, own 50 pairs of shoes or 50 purses, or spend their hard-earned money on alcohol, tobacco, gambling, and certainly not on drugs. They knew that a fool and his money are soon parted. So, where does that leave us? Everyone can achieve financial success. This is the American dream, and it is reality based. Traditionally, each successive generation has done better financially than the preceding generation. So remember, there are 4 ways to better meet your long term financial goals. You can increase your pay, you can make better investments, you can cut spending, and you can especially cut spending which carries debt and high interest rates. But here is the critical element necessary for achieving financial success, whatever your long term goals. Don't just cut spending, consistently spend beneath your means. Hey, be safe, be well, and may God bless.